Megan, I assumed you kept your... Okay. Welcome, everybody. We'd like to get started. Welcome. My name is Amy Marjoram. I'm an executive vice president with the Aspen Institute. Luckily, I'm based here in Aspen, Colorado. Hopefully, you're here for the session called Investing 2010. What do the markets look like and what are the risks? You can see this is a popular session today. This session is going to be moderated by Megan McArdle, who informed me that she just came back from her honeymoon in Hawaii, straight to Aspen. Congratulations. Megan is the business and economics editor for The Atlantic, and prior to that, she worked in various capacities with The Economist, including writing about economics, and oversaw the founding of Free Exchange, which was their economics blog, for those of you who are familiar with it. Her work history includes 3 startups, 4 years as a technology project manager for a consulting firm, summer associate in an investment bank, and here's the one I really like. She was, quote, an executive copy girl for a disaster recovery firm at Ground Zero. But while working at Ground Zero, she started Live from the World Trade Center, which was a blog focused on economics, business, and cooking. So hopefully we can throw in a few recipes here today, Megan, because I know that Bill Mayer is also a great cook, so maybe we can include cooking in our conversation. Anyway,
I've got a great one for roasted artichokes.
Okay, welcome.
Well, we have an exciting panel today, maybe less exciting than cooking would be, but still I think a topic that everyone's interested in, and we have 2 great panelists to discuss it. William Mayer is the senior partner of Park Avenue Equity Partners, a private equity firm. He was previously a professor and dean of the College of Business and Management at the University of Maryland, and for 23 years worked at the First Boston Corporation, which is now CSFB, where he held numerous positions, including president and CEO. He's currently a board member of BlackRock, Kelso, and Lee Enterprises, and is a trustee of the Columbia Group of Mutual Funds. So as you can see, we have someone who should be able to tell us what the heck to do with our portfolios. We also have Keith Banks, who is a president of U.S. Trust, Bank of America, Private Wealth Management, which provides integrated investment trust banking and lending services to wealthy and ultra-wealthy clients and provides comprehensive wealth management to affluent and high-net-worth clients. Banks previously served as president of Global Private Client Institutional Investment Management for Bank of America. So I'm going to start off. This is, well, at least for my portfolio, has been a terrible few years. And most of us out there, I think, are, as my grandmother liked to say, as nervous as a long-tailed cat in a room full of rocking chairs. Is the worst of it behind us? So that the first question, have we actually crested the worst of the wave, or are there more shocks to come, do you think? And I'll start. I'd like to address this question to both of you, so I'll just start to.
Sure, I'm happy to kick it off. I think the answer is we do believe the worst of it is behind us, both from an economic standpoint as well as a market standpoint. Having said that, I would tell you that does not mean it's going to be easy sledding from here. There's going to be, we think, still quite a bit of volatility. Quite a bit of uncertainty, and there are going to be certainly days when one will feel very uncomfortable with what they're potentially seeing. But at U.S. Trust, we do not subscribe to the double dip thesis. We think that this year we'll see in the U.S. about 3% real growth, call it 2.5 to 3.5. Faster overseas, 4 to 5. If you just look back, there's no precedent for a double dip. When you've got the kind of fundamentals we're seeing now, you have to go back in the last 60 years, really the Volcker days when we were fighting, obviously, runaway inflation, and Chairman Volcker took interest rates up to 20%. So high-level answer is we think the worst is behind us, and happy as we continue on to drill down into that for you.
I guess he's the optimist. I think the answer is, of course, maybe. and probably. And, of course, that's one of the issues we have in this environment. It is unprecedented. Nobody really knows how this is going to turn out. And you have the short-run view, and, of course, you have the longer-run view. But I think essentially for the next year or two, I generally agree. I think your estimates of growth are maybe a little high, and whether they're a little high or not, even at 3%, you'll have virtually no shrinkage in the unemployment rate. So as Alan Greenspan said, and I quite agree, almost certainly going to remain above 9%. And the significance of that to the investing world is, of course, from a political standpoint, that's a real problem for people in Washington who want to get reelected and stay in power. And I think they'll have a terrible tendency to further stimulate the economy.
So I'd like to pick up on what you said, no double dip.
I would agree with that. I mean, sort of minus 1% to sort of plus 2.5%, okay, maybe zero, and it's a little, does it really matter? Okay, no fast growth, no collapse.
What about a Japan style, just sort of steady stagnation for a decade or so? Do either of you worry about that?
You have to worry about it, but I don't see that as an outcome. I mean, if you look at the way Japan handled their crisis and how slow they were to act, and when they did act, the types of things they did, it's the antithesis of what happened here in the U.S., both from a monetary stimulus standpoint, a fiscal stimulus standpoint. We had, I think, fortunately, a head of the central bank who understood the risks, and the risks were deflation. And the risks were, depression is a strong word, but that was the mindset. We had to stay as far away from that neighborhood as possible, and we acted extremely aggressively, I think appropriately. So worry, yeah. I mean, when you're during these inflection points, you always got to be concerned about the what-ifs. We don't see that. I would say, though, if you think about Europe, I think it's a different ballgame. I think they are flirting with the risk, given the way they're responding, or the lack thereof, a concern still about inflation, right, as opposed to deflation. And with the influence of Germany in the ECB, on the ECB, and they're kind of continuing to fight that old war, I think Europe, if they don't get a lot more aggressive in their response to this crisis, I think you could be looking at a Japan-like outcome there.
45 years ago, my father, who was an economist and a banker, and from Europe, said, just never forget, in Europe, they are still fighting the inflation of the 20s, and the United States, they're still fighting the depression of the 30s. And it has become part of the culture, and Europe will have a tendency to restrain, and the United States will have a tendency to inflate. And here we are 45 years later, and guess what? As Keith says, you look at Germany, until very recently, a few months ago, Merkel was talking about we got to have a balanced budget. And here, of course, the kitchen sink and everything into a stimulus program. Some would say wisely, some would say maybe not terribly well aimed, but let's get some stimulus into the system. So I think in the short run, and by the way, if I had been king for a day, I would have done pretty much what we did in the United States, because the train was seriously close to coming off the tracks. And I believe that the combination of Geithner, Bernanke, and Paulson really did pretty much what they had to do without a playbook. A lot of mistakes as opposed to what they're doing in Europe. So in the short run, this will help us. What I don't know is in the longer run, when we're going to have to pay for this.
Mm-hmm. Do either of you worry, and there have been some increasing noises about, certainly over the last 2 years, about the United States, the quality of our debt. We've issued an enormous amount of debt over the last 2 years. An enormous amount of that debt is going to have to be rolled over in the next 2 years at presumably higher interest rates than we borrowed it at. Do either of you worry about the credit quality, with Moody's saying, well, the AAA isn't forever? Are we always going to be the risk-free rate, or is there a risk that people are going to start worrying about our ability to pay back the amount of debt that we've taken on. And what does that mean then for investment strategy?
Well, I worry about, if you look at the deficits that we're running today, so we got up to around, in 2009, 10% of GDP, reached only 3 times before that, once in the Civil War, World War I, and World War II, which actually was 3 times that number, right? But understandably why, and for good reasons. Now, as we recover, you'll see that number come down, just as tax revenues go up with recovery and activity, and the kind of spending we're seeing now to stimulate the economy begins to wane. We think that over this current cycle, you could see debt to GDP drop down to maybe more like 5%, which you can argue is a sustainable level if GDP grows at a commensurate rate. What I worry about, which is further out there, but as we all know, further out there becomes here a lot sooner than we like to think, and that is if you look at, as the baby boomers continue to age, you look at Social Security, you look at health care, we don't have a way to pay for that. And the problem is the numbers range from, it's a heck of a range, the contingent liability associated with that, anywhere from 50 trillion to 100 trillion, which is anywhere from 3 to 6 years worth of GDP. That's a scary thing. I don't think it's something we've got to be overly focused on right now today in terms of our investment decision making, but that is a big dynamic out there that could be very, very destabilizing.
I look out in the room, and of course I see a number of people that I think should be up here, and maybe I should be down there. So we have a pretty sophisticated audience that reads the same stuff we all read, talk to many of the same people. And I think one of the conclusions you come to after all of these years being around the markets and business is that you can pretty much expect the unexpected. So when you talk about debt and the euro, and I thought, well, okay, we're starting to have to pay the price here for the federal deficit. And yet, what happened? Well, for some reason, everybody decided, okay, Greece is a problem. Well, Greece has been a problem. But something happened, some tipping point came, and all of a sudden Greece, okay? So Greece is part of the Euro system, so the whole thing gets dragged down. And as you've heard the phrase, we turn out to be the largest pygmy in the room, right? That doesn't mean we're in good shape, but this gets to be one of the questions when you're talking about investing is relative to what? And so we have this deficit, and I think it's pretty clear that if something doesn't happen, and it's been written, right? So sooner or later, if you don't deal with the issue of entitlements as part of the budget, it's hard to make the math work in the long run. Some people say, well, that's out 7 to 10 years, but as Keith appropriately points out, the far time horizon tends to come in pretty close, much faster than you would expect.
Well, and in fact, Social Security went into deficit for the first time this year,
right.
7 years before it was expected to. So expect the unexpected.
Yep.
The euro. So, we talk about this being, the most attractive disaster on the block. And the euro has been giving us a lot of help on that for the last 6 months. How the way back when I was at The Economist, I was a skeptic about the euro. It's not a sustainable currency. It's not a good currency union. There's no labor mobility. They don't have integrated fiscal policy. All of the things that the United States uses to manage its somewhat suboptimal currency zone. Do you worry about the risk that the euro is going to dissolve? And if it does dissolve, what does that mean for the investment outlook? I mean, are you starting to consider that now, or is that something that you'll think about down the road if it looks more likely?
Well, I think in a much larger context, and the parallels aren't perfect, but when we formed this country, okay, it took 50 years to straighten out some of this stuff, especially we're still fighting over state and federal prerogatives, and we had a lot of problems with our currencies. And so I think that in a much larger, long-run context, Europe's not doing all that bad. However, having said that, there's some real dangers. You have, as we have in the United States, parts of the country which are economically quite strong relative to others. So you have in Europe, of course, Germany and Greece, probably the two extremes, although Spain is in terrible shape as well. And so I don't, first of all, of course, it would be a shame. I don't think they have a choice but to keep the euro together. I mean, I cannot imagine a Europe without the euro. I don't know how they go back.
But can you imagine a Greece without the euro?
Well, this is the same story we have here. You know, we don't have a lot of, the market tends to implement restraint on borrowing entities. So we have the example now of California, which you could say is structurally bankrupt. And how they're going to deal with that in the long run, I don't really know. So is Illinois or California analogous to Spain and Greece? And I think that they're obviously putting a lot of pressure on Greece from the rest of the euro. And of course, we have riots in the streets because, I mean, who do you know that voluntarily wants to give up something? I don't know anybody that is in that frame of mind.
I wouldn't disagree with Bill. I think what we're seeing right now are the challenges we knew would be there when you had the disparate types of economic scenarios that are playing across the Eurozone. As Bill said, it's as extreme as it can be, you know, from a Greece to a Germany. And the problem is when you have a single currency and a single set of policies and a one-size-fits-one when there are many, you know, the day was coming, the day has arrived. I agree with Bill. I don't see it breaking apart. I don't think the members believe that's a good or positive outcome, nor would it be. I think they'll muddle through this. I think they'll get out the other end. And hopefully, you know, they'll learn some things, you know, in the process that as they think about, you know, during better days, the next challenging days that will come, how do they better prepare themselves for that eventuality?
Just staying in the euro, and do you then expect a higher risk of default from countries like Greece and Spain, which basically they can't, if they don't have monetary policy to help sink their economies with the broader, I mean, does this actually then raise the risks inherent in the PIGS debt?
Well, it's the issue of sovereign default is, of course, a fascinating question that if you look back over the centuries, and in the most recent decades, of course, particularly with Mexico, what you tend to do is restructure your debt very much like a corporation would, because the concept of a true failure of a sovereign credit is pretty hard to imagine. I mean, you have periods like, you know, Russia defaults, you know, Mexico defaults, you do a restructuring, and you work it out over time. The problem here in this whole environment, nobody in this room really has had any experience in trying to figure out where to invest and how this is all going to come out, because this is as muddy as we've ever seen it.
Talking about our own quasi-sovereigns, both of you spoke a little bit about the states and you know, the muni debt market. Is it a good buy now, or is it something that, or haven't people priced in adequately the fact that eventually California may have to, and Illinois and New York and increasingly other states may have to say, look, we can't do it. Our pension debt is too great, and our resources to deal with the rest of it are too small.
Well, look, I think, you know, we still think munis are a good place to be. What they're not now is the slam dunk. You go in there, you take the shotgun approach, and you just get exposure to that segment. Obviously, a lot of states have a lot of challenges that need to be worked through. Some more extreme than others, but there are a lot of states that are still in very good shape. So I think, you know, especially given the tax environment we're in and will be in, that's a very, very attractive aspect to munis. So, you know, we are still very much urging our clients at U.S. Trust to have exposure there, but you have to really go in on a security-by-security basis, understand what you're buying, understand the dynamics of that particular entity, and if you do that, we still think it's a place that, you know, in an after-tax context is a good place to be.
I don't think it's very different from whether you're lending money to a corporation or an individual, and that is you have different kinds of municipal bonds, right? You have a general obligation, which means I trust you, and then you have, of course, revenue bonds, which are secured by revenues that are associated with an asset, And most people who are lending, surprise, surprise, would rather lend to an entity which has a revenue stream associated with an asset rather than saying, here's your money and pay it back in however many years. I think in this particular environment, and of course this gets to the question of what kind of a return you could get, is that I think in this environment, buying 30-year California municipal bonds is probably not the best thing you could do. You know? Buying a 9-month, 12-month, 18-month, where you're going to be the stout and preferably secured by some revenue stream, as I said before, if you're going to go in that direction on an after-tax basis, municipal bonds of some kind do yield more than the taxable market at this point.
So talking about returns a little bit, because this is something that, I just finished a column on the equity premium, which will be out on the Atlantic's rather lengthy production schedule sometime in the fall. In my whole lifetime, as my old boss said, basically all you have to do to earn money is just basically like breathe and invest your paycheck. And as long as you did those two things, you would be making a really quite comfortable yield on a relatively small amount of savings. Do you see that being true in the future, or did we have an anomalous 20-year run that's now over?
Go ahead, Bill.
Go ahead. Call me in a couple of years and I'll tell you what happened. You don't know, but that doesn't mean you don't try. And once again, we try to make this pretty complicated. And I know in the case of volatility index, derivatives, overlays, buying insurance, and yet at the base, it's not that complicated, right? You have 3 variables only, right? Your risk, okay, your liquidity, and your yield. And everything you do is some variation of some combination of those three items. And so today, I think that what you do is you're obviously, all of us are focusing a little bit more on the risk part of that than the yield part of it.
And yet you still hear tell of bond fund managers who are going out and leveraging up their portfolios hugely in order to give equity-like returns from their bond funds. I mean, is that still a big problem? Or?
Well, I think what we've
learned... Is it a problem, really?
Well, it's a problem. Well, I think what we've learned from the past few years, without any restraints whatsoever and without transparency, you're going to have people having a good time in the marketplace, the traders. And there are a couple of things that have really changed from, let's say, 20 years ago. With all of the major firms being public, you're really literally playing with other people's money. So some of the self-restraint that came in when these firms were partnerships, and it truly was, wait a second, that's my money, gives you a very different dynamic. And then, frankly, with the leverage, and how did these firms get leveraged 35 times to 1? Because the market allowed it to happen.
Equities, if you step back and just think about investing, right? Investing in reality is a very counterintuitive endeavor. What seems most obvious and most easy, most often, eventually is wrong. Think back in 1999, right, when it became very, very apparent we all should own equities, we all should own tech, we all should own .coms. Every day they're going up, people are making a fortune, and guess what happened, right? It blew sky high. And think about, in the latter days of 2008, the early days of 2009, and I think March was the inflection point in the market. It couldn't have been a scarier time, right? We're talking about deflation. We're talking about depression. We're talking about global systemic failure in the financial system, on and on and on. And the market went up 70%. And so, what you got to always think about, and if you step back and think about what Bill and I talked about, if we do get growth of 3% in the U.S. and 4 to 5 or whatever the number is of that order of magnitude globally, and you think of how exposed U.S. companies are to not only U.S. growth, obviously, but global, and you think about how much operating leverage is inherent right now in these companies, that's a very positive environment for what we think is the continuation of very dramatic profit growth. And so, when I think about investing, what I would encourage people to do, you've got to remember cycles. You've got to remember reversion to the mean. I think large cap equity over the last 10 years, and I may be wrong on this, but it's orders of magnitude a right statement, may have been the single worst performing asset class over the last 10 years, and fixed income just crushed equities. The question to ask yourself is, over the next 5 to 10 years, do we think fixed income will be outperforming equities? My answer to that is no.
Well, let's talk about this a little bit. Because
I knew that would get it going, Bill.
This is what I've been thinking about, for especially a lot of people who sort of grew up in the era I did. I got my first job during the tech boom and so forth. Equities have always been where you put your money, good times and bad. And is it possible that I look at the S&P now and the PE is still 20, which if you look at historical averages is at the very top end of the normal range that it trades in. Now you can argue that because of the recession earnings are lower, but we've seen corporate profits start to rebound and it still looks high to me. Have we seen the equity premium that we've historically gotten that 6-8% above what you get on bonds? Has that eroded, do you think?
Well, but on the PE, and PEs are always interesting because depending on what you're doing the math on, the PE, I believe, and it depends on what the numerator and denominator are. So in the numerator, we think that the denominator, we think earnings this year, we're going to see $80 from the S&P, give or take a couple of bucks. So call it 78 to, I wouldn't say 82, maybe 78 to 80. And you look at that, so we see a multiple closer to 12. And if you look at history since the mid-'80s, it's been closer to 15 on average. So I would argue you've seen this multiple contraction due to fear. I mean, the thing to remember at inflection points of cycles, fear and greed drive the day. In late '99, greed drove the day. And when fear and greed drive the day, you get a disconnect between fundamentals and valuation. They ultimately reconnect. So in the greed phase, like in '99, they reconnect in a very scary and ugly and violent fashion, and people lose a lot of money, right? Those last folks that got in that dot-com bubble, and the same thing is true at the bottom, right? So when we're seeing fear manifest itself to the point we're not seeing those earnings, to your point, at least as we see it, being fully reflected in the PE multiples or the stock prices, which we think creates an opportunity, assuming the economy continues to grow and earnings growth sustains.
Okay, so to have economic growth, you have to have credit, right? So to have credit, somebody's got to be prepared to lend money and somebody has to borrow it. So we have an environment on a macro level in this country where we've tightened up the capital requirements for the banks, the denominator, right? We've told them you have to have less leverage, so we're going to reduce the numerator. Right. So then you say to yourself, so how are you going to lend money? And then the borrower, a lot of people here run companies, have their own companies, and you're not going to make any kind of major capital commitment unless you have some sense of confidence of what the outlook is. And one of the problems we've had here for the past few years, there's no confidence as to what the future looks like. And in the absence of that, we all tend to hold back and say, well, maybe I'll wait a little while, because the whole, one of the premises we try to go through is this whole business about, risk-adjusted returns and investments. And so, I see an environment where, frankly, I think we will have growth. Okay, once again, but people are going to try to have this growth without adding people. Right? So I think the earnings will go up, and I frankly think the market is going to have some pretty good areas in which to invest. The $64 question, of course, which areas? Is it infrastructure? Is it tech? Is it consumer products? Is it service? Is it financials? Is it large cap? Is it small cap? You get yourself a headache quite quickly when you try to go through those.
Do you have any thoughts that you care to share with the audience on that?
Well, I know I'm an aberration in this group. I've always had sort of a barbell approach to things, and this will probably make you really throw up, but that's okay. Is try to keep some liquidity, and I tend to have always gravitated to more illiquid investments, whether mostly private equity, but that's just me. But that fits, and this is something I think is very important for everybody in the room. Just like everything else, well, what are you trying to accomplish? Are you trying to preserve your capital, or are you trying to grow your capital? Well, can you tolerate losing 30% of your capital? What would that do to your standard of living? And so before we even start talking about, and what I just said is not exactly rocket science, it's certainly not a new concept, but so many people don't go back and do the basics, which is, what am I trying to do here? Because as I've often said, it's kind of boring, to buy something and hold it. It's a lot more exciting to go out and trade and do wherever you want. And so, the discipline associated with your specific objective is, I don't think you can talk about anything until you do that, and then you're going to have 122 different answers of how to invest.
One of the things that I sort of see because I read a lot about very basic level consumer finance, and when you look at the consumer savings rates, what I see when I look at the baby boomers is a large group of people who need to both grow their capital and preserve their capital because they're coming up on retirement and they didn't do the savings that they should have done 20 years ago. And that is one, to me at least, one possible reason that you've got such high prices on equities, why we had such high prices on houses. People will continue putting their money into asset markets no matter what, because they have to in order to retire.
But it's interesting, they're not. I mean, I don't know the exact number today, but not many months ago, and it's probably not a whole lot different, individuals were holding $8 trillion in cash or cash-like instruments, earning nothing. And if you add on top of that short-duration fixed income, which doesn't get you a whole lot more than nothing, that is an unbelievable statistic. And to your point, the math doesn't work. So I think you're right. The kind of the push-pull right now for people is as they think out not only the rest of their lives, but generationally what they need to do, want to do, philanthropically. They're sitting in a low or no returning asset class or classes. And I think that's part of what gives us some comfort, because that money has not moved. In fact, I think last week or the week before was one of the biggest negative outflows of equities I think ever seen. So the nervousness and the inflows were back into fixed income again. So one thing I want to make a point. Bill made some great points as always, but around credit and the need for credit to sustain ultimately the recovery we're seeing. But one of the things that we feel good about, which I think gives you some air cover for a while. It gets back to the same thing. Companies have record levels of cash right now. Again, 1.416 trillion, whatever the number is big. And even more importantly, they've got record levels of free cash flow. Because they're not spending on people or capital equipment, right now you're just free cash is exploding. So there's a long way we can go here, and companies can go before they're going to need to get the pump primed a bit from credit. Ultimately, that's going to be an important part of the equation. But again, we feel good knowing that companies have that liquidity, and we think what they're going to do with it will be they do need to start hiring people. So I'm with you. I mean, we're not an employment bull, but we do think this will be a recovery that creates jobs, because they have to hire people, right? They're past the point of the productivity thing is going to start to tip. They got to go out and spend on capital because capital investment's low. And importantly, they're going to start to buy back their stock because it's cheap. They're going to start to raise dividends because they can. And I think you're going to start to see, and I think we may be starting to see some already, Bill, a pickup in M&A activity, all of which, when you add it up, is a good thing for equity markets ultimately. We're not saying this, but we're saying, we do think the markets will get an underpinning at some point and start to do better.
Okay, I'll make my case of how we're going to get out of all of this. All right. So when you have an equilibrium that gets broken, okay, you have a very, very important inflection point. And what we had here in 2008, we had an equilibrium that got broken. And at that point, one of two things, or one of a number, but generally at least one of two things will happen, is that the thing goes completely off the tracks and completely breaks, or it muddles along. That's a phrase our old economist at First Boston told me, is that if you can muddle along long enough without the train going off the tracks, things will recalibrate to a new normal. And at some point, when you have a new normal, you can start to grow again. When you approach a new normal, the market will start feeling, by market I mean everybody, not just stock market investors, people running businesses, corporations, will start to have some confidence that the train did not go off the tracks and is not going to go off the tracks, and you can start to rebuild. That should take years. So depending on when you want to start the clock, and let's start it, you can either start it in late 07 or certainly no later than the middle of September 08 when Lehman went, because that's when it was lights out. Right. In the economy market. Everybody fled to the hills, okay? Nobody could borrow from each other. Banks weren't lending to each other, this close to everything going off the tracks. And I think generally we've been muddling along, not bad, given what almost happened. Mm-hmm. Then if we can muddle along without any major disruption, I think we got a good shot in a year or two. This has taken a little longer than I would have expected, but I also reminded what that economist said to me, never forget, when something happens and the pendulum swings, the pendulum will swing further in either direction and last longer than you can imagine.
I'm going to ask one last question.
Please.
I'm going to open it up for questions from the audience. The government. So one of the things that an argument that I've been hearing a lot is that that companies aren't investing. They're even the ones that have access to credit, they're holding on to their cash. They're not hiring, in part because they don't know about the economy, but also in part because they don't know about the regulatory environment. And that even on the investor side, people are starting to worry about, are my tax-free investments going to continue to be tax-free, all of these things. So do you see those, when you talk to the heads of companies, when you talk to investors, do you see those worries? How real are they and how much difference do they make?
Go ahead, Bill.
I don't really want to answer that.
That's why I was being a gentleman.
Look, I've concluded I don't know which party is worse from the spending standpoint, and there's very little responsibility in the government from that standpoint. And I think that in all walks of our life, and in particular when you're talking about committing capital, when you have a lack of certainty, you tend to be more conservative, and that sort of makes sense to me. And so until you have some sense that you know what's going to happen in terms of tax rates and regulations, I don't know why you should be making major capital commitments.
Yeah, I think you're absolutely right, and Bill's right. I mean, the uncertainty is a bad thing, and I think where they're getting so uncertainty is not good, and there's a lot of it. Yeah. Where they're getting certainty, it's not good certainty. They're seeing certainty of higher taxes. They're seeing certainty of higher costs in the form of health care, et cetera. So, and the key is small business. I mean, if you really look over a cycle, employment growth comes from small business. And they've been and we have a lot of small business and mid-sized business owners as clients. As I get out and about and meet with those clients, these are very sophisticated, smart, savvy folks, and they're worried. They're concerned. They're concerned about what they're seeing. They're concerned about what they still don't know. But the hope is, and Bill kind of said it, as we continue to muddle along, we get more clarity, there's more signs of good things going on, and as the pendulum starts to swing a little bit more toward the constructive end, I think they'll kind of get off the dime and start to do the things they always do at an inflection point in a cycle.
Just one last thing. I actually think that in terms of whatever regulations, tax rates, whatever it is, please do it. Because once you know it, the adaptability of the American is quite remarkable. They'll figure out a way to live with it and do it. They may not like it, but at least they'll know what the rules of the road are.
I agree with that.
So I'm going to open it up to the floor. I'm going to ask you to end up. And second of all, because this is being recorded, to state your name and your affiliation before you ask your question. And do try to keep them relatively brief questions, not speeches. So do I have any hands in the audience?
How about Stefan?
Right there.
Wait for the...
Quickie.
No, we have a microphone coming to you. I'm going to identify the next questioner while that's moving so that we can keep this going. Does anyone else have a question that they would like to ask our distinguished panelists?
Hi, I'm Stefan Edlis. Is it on?
Yes.
Just a quickie on Social Security. Ever since Reagan fixed it, we've been in the black on Social Security. Currently have well over $2 or $3 million dollars in treasuries in the surplus. Look it up. My question is this. Having stayed away from equities all my life, I had an epiphany in March of 2010. And I need for you to tell me what the face in the mirror is when I shave in the morning. I bought 5 stocks, AT&T, Verizon, Kraft, GE, and Northern Trust. So where am I? How sorry should I be?
Are you directing that question to Bill?
I think.
Go ahead. Look, like everything, you've got to have the time, a time horizon. So when we either on behalf of our clients invest, whether it's equities, fixed income, whatever it is, we're not investing thinking that we're going to be right necessarily over the next day, week, month, or year. We're really looking out, saying over the next 1, 3, 5 years, how do we position someone's portfolio to again, according to the risk tolerance they have and all the other complicated things that factor in. So, to answer the question is over what time frame where you think, then I think you're fine.
You're fine.
I think you're fine. And, if you see weakness in stocks that you fundamentally feel good about, where the valuations are attractive and you get weakness, that's an opportunity to buy more in our view.
Do we have other questions? I mean, I'll keep asking. Yeah, you're right here.
B what?
Do I get a B?
Oh, Stefan, we always give you an A.
Seems that you
It's on.
It seems that you have, or there are 4 interlocking major macro issues: jobs, sovereign debt, commercial real estate, and municipal and state debt. You've dealt with 3 of those. Let me ask about commercial real estate. Mm-hmm. About $1.6 trillion comes due over the next 5 years. We've been playing pretend and extend over the last several years, since 2008. Could you address that and how you see that impacting the financial services industry's ability to loan to small business and medium business?
Mm-hmm. I'm happy to take the first crack, John. A, good question. B, you're right. So if you think about commercial real estate, it was the last, it kind of lagged the decline, right? We saw the consumer side roll first and all the related credit card, mortgages, et cetera. Commercial kind of hung on longer than we anticipated, but then it rolled as we knew it would. So it lagged the downturn. It'll lag the upturn. There's still a lot of pain to come. We think it's going to be certainly for the better part of this year, probably into the early part of 2011. And keep in mind when, what banks need to do, from a provisioning standpoint, is they need to look out at the loans and the exposures and make a determination, which I can assure you, because we do the same thing in U.S. Trust. We've got $50 billion in loans out to U.S. Trust clients, so we have to do the same exercise. You have to be very rigorous around how much of that money are you going to get back and get back on time. And if you're not, you need to provision for either the eventual loss or the pushing out. So I think what happened with all banks as we went through 2009, mainly because the regulators insured it and banks wanted to make sure they had a complete picture, is they are taking a very realistic view right now of the outlook for commercial and other exposures. And so the lending plans that those companies have, I think, are based upon a realistic view of where they still have a trouble area. And I don't think it's going to affect. I know at Bank of America, Brian Moynihan, which we're part of, so Brian Moynihan made the commitment going into this year that the bank would make $5 billion of new loans to small businesses alone. And I think many other institutions are out there in a similar mode. Bank of America, other banks understand that is that's where the real leverage point in the economy is. We got to keep small business healthy. We got to help them get back on a growth track. They've got a lot of good free cash and cash to get there on their own initially, but credit's got to be part of that, and I think it will be. So I feel pretty good that, yes, it's an issue. I think we have a realistic view of it, and we mean the collective financial institutions, will be able to do what they need to do to to support that segment.
I don't know how much of the commercial real estate should have never been built. And it shouldn't shock the system because we know it. My guess is most of that stuff will get refinanced, and but that doesn't speak to at what price level and who's going to take the loss. I mean, clearly the equity in a lot of this stuff will go, but it shouldn't. It doesn't mean it won't, but it shouldn't.
Over here in the yellow shirt, a woman.
Thank you. As somebody who was a value investor and got killed and took the hit, am I incorrect in feeling now that the market in equities is really a psychological thing now, and that the presumption that people have, it's just going to be emotional from now on?
You know, the point I made earlier, and again, you know, I don't want my comments to be construed that I think we're off to the races here. You know, Bill used a great word before, which is a word I subscribe to. It's the word muddle. And I think, you know, the better part of the rest of the summer, maybe even to the early fall, there's enough uncertainty out there and enough conflicting signals where, you know, this fear and this emotion will continue. We're suffering right now from what I call the data point du jour-itis. And what that is we're all so desperate to get clarity, right? Good or bad clarity, but clarity nonetheless, that we look at every data point that comes out every day, and God knows there's plenty of them, and we try to then think about them, extrapolate them. If they're good, the market's up. If they're bad, the market's down, and you know, and all that stuff, right? And it's like when you're driving your car in fog, right? We find ourselves leaning toward the windshield, like that's going to matter because we think we can see better. So part of what's happening is we are overreacting to data points, you know, on any given day in any given hour. That will keep the emotion high. But as I said to you before, we're still, in my mind, in the fear phase of this inflection point. So you can see a disconnect between fundamentals and valuation. At some point, fundamentals and valuation reconnect, whether that's going to be in a month, 3 months, or 6 months. We think, and I think when it does, it'll be a positive thing for equities, but I cannot tell you at what point the emotional/fear aspect of it will begin to wane. But, Bill, I don't know what you're...
Well, I think we all, when we, you know, the market was down almost 1,000 points intraday, what was that, within about a month ago.
Yeah.
So, you know, what was that about? Well, it was a trading thing. And so markets are going up and down by hundreds of points when, as Keith appropriately points out, nothing really has changed. So that's not really investing, that's trading. And yet we all in this society have become a little more, oh my God, you know, look what's happened today. See, Dixon's being pretty patient here.
Question for both panels.
Can I ask you to state your name?
Yes, Dixon Dahl from San Francisco. What percentage of a typical portfolio would you advise clients to hold in non-dollar denominated assets these days? I realize it's not a one-size-fits-all, but define typical however you'd like.
You want the first crack?
Sure. The answer is, of course, some. How much, as you point out, is an individual preference. And, you know, there are classically two ways to do this, right? You can buy McDonald's, you can buy, Colgate-Palmolive, and you really do have an international exposure. Or you can go and you can buy foreign securities of whatever like you want, whatever industry, on a foreign exchange, or buying an ADR here in the U.S. But I think in the very long run, I mean, you know, this is not exactly new news. The Supreme of the United States will have a tendency to become a little less than a little greater. That doesn't mean we're going anywhere, but that means that in terms of the growth in the rest of the world, we may be growing at 3%, but everybody knows about, of course, India and China, and the question there is, how do you do that?
Bill made the exact right point. Again, it's hard to say the right a number, right? But we absolutely think, as part of an equity strategy, international and in particular emerging markets should be part of that. And Bill said, I mean, the key answer there is the differential in economic growth. I mean, you got emerging markets probably in the 6 to 9% real GDP type of growth. You got Europe and Japan 1 to 2, maybe. U.S. 3, maybe. So kind of by definition, you want to have exposure to where the growth is increasingly is not only today but will be as we move forward.
I'm going to take the last question. The lady in the black shirt right there.
Hi, Tracy Strauss from New York. Are there any socially responsible funds that either of you would recommend?
No. What are you looking at me for? None come to mind. I mean, we only because we don't recommend funds. I mean, I can't. That's not what we're here to do. We are certainly very supportive of that. We think it's a great thing. It's increasingly more and more money is moving toward that direction. It's important to people. It should be important to people. We certainly support that at U.S. Trust. But again, I mean, none comes to mind that this is the one you should be in, because like everything else, I mean, it's really dependent on a lot of variables, and it's really you got to really fit it to the needs and the risk tolerance of that person or that family. But it's certainly it's burgeoning in interest, and more dollars are going that way. So important trend.
I don't know. I find it hard enough to make money anyhow. And
socially irresponsible.
Yeah, I mean, but I think everybody tries to be responsible. But the definition can vary quite broadly amongst people and what they define as socially responsible investing. And I know there are funds out there, and you can look at them on the internet in terms of category. And I'm just simply ignorant on the question.
Thank you, and I'd like to invite a hand for our panelists, sir.
Thank you.